Also, it's interesting to see some profit taking in corporate travel, IDP education and the like. Of course, you wonder about whether potentially you know what's going on with China, maybe or something there going on.
Yeah, okay, lots to talk about with Martin Crabb. He is joining us from Shaw Partners live at our Barangaroo studios here. Let's go against the grain, start with some of the company news out there today. Domino's, Collins Foods amongst the best performers. What do you make of that?
A little bit coincident that they're both up by 10% today because Domino's had an announcement yesterday. It was all about their future, and Collins Foods was actually an AGM update. These are master franchises, so they don't actually own the brands. The brands are owned by American companies. So Collins Foods are master franchisee of Yum Brands, who owns KFC and Taco Bell and these other brands. But they hand out territories, a bit like Coca-Cola does. Coca-Cola hands out bottling territories to subsidiaries. These are master franchise. So Domino's Pizza Enterprises is a master franchisor for Domino's Pizza in the US. So you can track the headstocks, but these companies are both doing incredibly well in Europe, in places like Holland, Belgium, France, Germany, and Japan. I mean, Japan's a great market. Who would have thought the Japanese would be big pizza eaters? But Domino's seem to be doing really well in that market. They've got a target to open 1,000 stores there. So market just loves these growth stocks. I mean, we've had a month of where we've had a breather from structural growth stories, and that sort of ended. It's now December, it's a new month, and people are jumping on these things because you can see the growth. Even though the world's kind of a rocky place, you can see these companies just opening more stores, selling more pizza, selling more burgers, selling more chicken. You know, we can't get enough of the stuff, right?
It seems to have a fairly simple business model, but when you overlay the tech side of things as well, particularly when it comes to Domino's, what can you do with that information that you have about those customers, about eating habits, what they like in pizza and the like, to go and transfer it to other areas?
Domino's can do a household-based profitability model, so they can work out how many pizzas the Crabb family orders, what time of day or night they, what they order, how long it takes to get it there, how much it costs to get it there, and can I put a store closer to the Crabb household to make that household more profitable? So they gave an example on their investor call yesterday, showing how they put an extra store in a territory and boosted the profitability of the territory quite significantly. They call it fortressing, which is a little bit of a scary word, but it's all about how they use data. To your point, David.
Yeah, and then that increases their store footprint, and it just makes it unattractive for other
competitors.
Pizza joint operators to move in. Interesting space. Would you invest in Domino's Pizza or Collins Food?
We own Domino's in our large cap growth portfolio. That's the place for it. We don't own Collins Food just because it's a little bit too small. But I think Domino's, even though it's pretty expensive on a PE basis, you can just see the runways getting quite attractive. So it's a stock you just want to buy and hold.
Another news point out today was Sandfire Resources. We spoke with the CEO just a moment ago, Carl Simic. He's really, really keen on this whole Botswana, not just the T3 announcement that came out today about that project, but the fact that they've got all of these satellite mines and projects and opportunities, and they're going to spend on exploration. Do you like the story?
Yeah, we do. We've been a fan of Sandfire for a while, but just watching it languishing. I think we've got a $6.90 price target, and somewhere in the fours even after today's move. So the copper price has been going nuts. It's up to almost $3.50 a pound. And here's a copper producer just going sideways in the market that's getting better. So the market does not like mine life with Sandfire. That's always been the issue, like it was with Oz Minerals years ago. But this Botswana complex, it's almost a complex, isn't it? Does look like a game changer. And they're in a very good position now to continue to grow production. And if you add mine life onto this company, all of a sudden it can start to grow. So we think, $6.90 does look like a bit of a stretch, but today was lots of good news, not just on that, but also some exploration updates as well. So lots of good news there.
Well, I did ask him. I said, what the market has not, been ascribing value to is these projects because there hasn't been a timeline. Just picking it up in some broker notes. And he said, well, now the brokers should be doing their homework because now we will say that production is happening, in 2023. So.
Well, they paid $170 million US for those assets in Botswana, and one broker note had them valued at $50 million. So they hadn't even put any value in for them. Had a quick look at it before I came down. They've got a $3.15 copper price in their feasibility study. The spot's $3.50. So if you're bull on copper, there's going to be significant upside from this company.
Okay, that's Sandfire, and the shares closed up by close to 9%.
Yeah, good day.
Martin, we get the national accounts here in Australia tomorrow. I'll probably write about them. One thing in particular, I'm very keen to go and see the information is the household savings ratio. Now, we've seen some alternate data that's came out via the RBA on deposit levels at ADI, so authorised deposit institutions, showing continued swelling of growth of deposits. Now, looking forward, that's going to be firepower, fiscal firepower that's been left over that can be deployed to go and spend.
Yeah.
How would you go as an investor position for a continuation of strength in that area?
Yeah, it's a hoarding phenomenon. It's a global phenomenon. The same thing's happened in the US. The deposit there has gone nuts. Even though you're earning no interest on it, people are just, they're still feeling a little bit of pain from March and April this year and concerned about their job loss. As the economy comes out of lockdown and people get a bit more comfortable, that's 9% of GDP that's sitting in deposits. It's a 9% GDP increase in deposits in the past 12 months. So there's over $1 trillion sitting in deposits. It's a crazy number. So that's going to work its way into the economy. So a lot of investors have been fading retailers. They said, it's pull forward demand for whether it's groceries or electrical goods or these things. My view is that money's going to find its way into the economy next year, particularly if there's a vaccine and that becomes effective. And so that's a significant boost to spending. And the government's probably going to keep some of the stimulus measures in place for a little bit longer because they're worried about that fiscal cliff. So I think the setup's for a really strong economy driven by the consumer next year. So I don't think you want to be short retailers. We've added Woolworths back to the portfolio because it missed this rally. Like the market was up 11% last month. I think Woolies went backwards. So I think it's worth adding a couple of those names to the portfolio.
Especially as we start doing our Christmas shopping
Exactly.
and all the food that we're looking forward to eating. So if you think about a thematic as well, is it too simple to say that you look to those names that have also, bricks and mortar plus the online, or do you tend to skew more to some of the pure e-commerce names?
Yeah, the issue there's just been valuation. I mean, things like Kogan and Temple and Webster, they've had incredibly good runs. Do you continue to pay those higher multiples in a normalising world? I'm saying I'm happy with JB Hi-Fi. Yes, it's exy, but it's nowhere near as exy as some of those things. And Woolies, which is more of a staple, rather than going into the more, I suppose, the higher risk, higher return plays like the Kogans and Temple and Webster's and Marley Spoon and those kind of companies. So stick with the big caps, a bit more safety, maybe not as much sex appeal, if I can use that term, but certainly it's still a good return.
Well, I went shopping on Saturday, partly to get out of the heat here in Sydney, and JB Hi-Fi still had security at the front, people lining up. It was a busy place to be.
Yeah.
People are still out shopping.
Martin, just to go finish off, expectations for December after the loudest game for the All-Ors since March 1988.
We've got to have a breather. I mean, I think I said that last week when I came on here. I just feel stretched. And some of the prices people have paid. I mean, NAB, which is a pretty boring company, is up 30% last month. So it just feels like we have to have a bit of a breather. I know from fund managers that we speak to that there's fatigue out there amongst them. So a couple of deals have been pulled just because I think the market's just got ahead of itself. There's a lot of deal flow. There's a lot of money's gone into the market and people just want to have a rest. So, it's always difficult to say because there's obviously always macro issues going around. But, I think people are pretty happy to put the queue in the rack for 2020 and start thinking about next year.
Yeah, we're starting to allow our minds to wander to our Christmas holidays,
Exactly.
I think.
Nadine's still backing the Santa Claus rally.
Okay, Martin Crabb, thank you so much for joining us. Always great to have you joining us from Shaw Partners as the CIO there.